And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani, but I bet you knew that. One of the biggest IPOs of 2024 has been the Magnificent 7 ETF. It's attracted $800 million in assets. It's been a huge hit. But what about the other 493 stocks in the S&P 500? Some investors concerned about concentration risk are looking to go the other way. Now there's an ETF for that. Let's talk with Sylvia Jablonski, CEO of Defiance ETFs, and Todd Sohn, ETF and technical strategist at Strategas Securities. Sylvia, you launched the ETF, tracks the S&P 500 minus the Magnificent 7. Now, why do we need an ETF that cuts out the Magnificent 7?
Well, I think the Magnificent 7 have been on an absolute tear. They've rallied for many years, particularly the last year or two, but now we're starting to see valuations getting a little bit loftier. We're starting to see easing monetary policy, which favors broadening markets. And actually, we have a lot of advisors that are realizing that they have such an over concentration of exposure to these names, whether it's directly through the single stocks, whether it's through the S&P 500 holding 33% exposure to this, or the various thematic ETFs and things that they have. And so they're really neglecting these 493 stocks, some of which are doing well and are more than outperforming the MAG7 and the S&P 500. And so I think it's just time to add that diversification and consider it a hedge.
You know, we always talk about diversification. This goes back to my old mentor over at Vanguard, Jack Bogle. But I hate to ask the obvious question, what do investors gain by having a more diversified exposure?
Yeah, well, I think if you only have exposure to the MAG7, or if you have so much exposure to the MAG7, whether it's again through your ETFs, through the single stock names in the S&P 500, when they rise, you do great. But when they fall, boy, do you suffer, and do you feel the losses in your portfolio. Broadening out the exposure to the other 493 names, which, arguably we haven't talked about that much because the MAG7 have been, kind of like the hot kid on the block, and now they're starting to perform. And I think that there's some tailwinds in coming years.
So what does this ETF look like? What does the S&P look like without the Magnificent 7? What's in this? What's the biggest holdings? What do you hold?
Yeah, I mean, you can look at Eli Lilly, Broadcom, JP Morgan, Berkshire Hathaway, but there's some other names in there, like Palantir is one of the big AI stocks that is in there. It's not a MAG7, and it's doing absolutely great, over 160% year to date. So,
well, we're looking here. This is the current largest holdings here, which makes sense. It's market cap weighted, right?
Market cap weighted.
So obviously, after the Magnificent 7, here's what you're looking at: Broadcom, Lilly, JP Morgan, Berkshire. But what I want to point out, let's put up the next full screen, is the return has been great here too, as well. So look here, we're looking at this. Todd, I want to just turn to you now. Each of these popular indices, they've had this heavy skew towards three names. So the S&P, NASDAQ, and essentially the Dow. Though NVIDIA is not in the Dow, but Apple, Microsoft, and NVIDIA have had this heavy influence. They're at the highest levels of concentration in the S&P in, I don't know, what, 30 years? You always like to say to me, momentum, don't fight the momentum. But investors should be very aware of their ownership concentration. Let's just put up what we've got here for the top three stocks in the S&P 500. But 20%, top three stocks in the S&P 500. You could slice and dice this a million different ways, but three stocks here. Look at that concentration there, 20.6%.
We have unprecedented levels of concentration skews within not only the S&P 500, Russell 1000 growth. These three stocks, and then add in the rest of the Magnificent 7, are over, I think, 60% of that fund. So if you have a portfolio that has an S&P 500 fund, large cap growth, and maybe you have a tech sector fund in there too, you have major exposure to these small core of names. It's been great this cycle, but to Sylvia's point, the rest of the index has been ignored, and at some point the music stops. And so I think there's this really interesting dichotomy going on in the ETF industry. There's Sylvia's product, which is saying, let's focus on the rest of the index, the bench, right? And then you have other issuers that are really saying, you know what, just go big or go home. And I think that part of the equation is getting a little bit off sides, especially when you look at flows to tech ETFs and whatnot. And so that just leaves me a little bit hesitant to want to continue to skew that way. I like the idea of looking at financials, industrials, real estate for 2025 to at least broaden out and diversify your exposure.
Well, there is certainly evidence that diversifying pays some dividends for investors. Let's put up the returns here for the Magnificent 7, that they had excellent gains. We put that up, except for Tesla. But look at Sylvia's here. The largest holdings in this MAG7 ETF, 57% return for Broadcom, and 53 for Lilly. These have all outperformed the S&P 500. Exxon's kind of in line. This has not been a terrible year for the stuff outside of the Magnificent Seven that are the largest holdings. Is there a way to backtest any of this, or is it hard to figure out how to do this?
Yeah, I mean, you can backtest it, but it looks the way you would assume, right? When the Mag 7 are rallying, then the S&P 500 market cap will outperform the rest of the 493 names, right? Because you're getting that momentum from the top 7 names. But I think the point is just this, that these names have run up, and Todd made a great point. If you're over allocated to this, you already have it, right? We're not saying get rid of it. We're just saying to diversify out, because if you have any kind of setback in AI, earnings targets are incredibly high. If the Mag 7 doesn't meet or beat to the expectation of the retail investor, you got to pull back in these names.
Well, we saw this with NVIDIA, pulled back 30%
right,
at one point.
Absolutely. And I think with the other names, the bar for earnings beats right now is a whole lot lower. So the upside surprise potential is higher. They might get some positive momentum there. Valuations are lower. There's a good story here.
Todd and I, we cover this business microscopically, and it's amazing this idea didn't come up earlier. I guess the Magnificent Seven, well, it's been around a number of years. The Mag 7's been 4 or 5 years already, and the Mag 7 ETF was a year and a half ago. I think it was early 2023. So I guess it takes time to sort of seep into the consciousness, but it's such an obvious idea. And what I like about it is it's so simple. I don't have to explain zero data expiration options or derivative ETFs or complicated buffered ETFs. I can explain it to my mother.
Exactly, and when clients speak to us about it, they say things like, I have so much exposure to the Mag 7, I don't know what to do. How do I diversify it? And we got to thinking, just subtract 7. It's that easy, right? And there are a lot of products that help you hedge your portfolio or non-correlated and things like this. But if you want broad-based equity exposure, you have a ton of Mag 7. Why not just put this out there and let the market cap run up on the other 493 names? But
concentration is not going away. You saw BlackRock announce they're doing a 20, top 20, not doing Mag 7, top 20. So they're trying to capture pieces of this. An interesting idea.
BlackRock has that. Invesco has Mega QQQ that's going to come out soon. And whenever you start to see a theme of, let's just keep going more and more concentrated, it usually means go the other way. And that's where the XMAG 7 product, I think, would come in. Same thing happened with covered call funds 2 years ago. Everyone launches a covered call fund and the market rips. And then innovation and disruption 4 years ago. Everyone needed an innovation disruption product because of the success of ARK, credit to them. And then all those stocks blew up. So there's this recurring theme now of go big and stay to these heavyweights in the index. And so when I just see these breadcrumbs, I start to get worried about that segment of the market.
So it's certainly true that they follow, the ETF business is a trend follower, essentially. It tries to think of what the public is doing, and this is a pretty obvious product at this point. So some companies are still going towards concentrated bets, expanded Mag 7. They're doing that. BlackRock is doing that. They just launched theirs. And I think that's an interesting product. And you're going the other way. There is the triple Qs, right? They're doing one too.
Mega QQQ, which is basically going to slice off 90% of the NASDAQ 100. So
yeah. So does the concentration risk worry you? You've said it before, but I have to say, can I be a little agnostic or maybe dumb? Is it fair to say I'm not that worried because we have a paradigm here, AI, that may be once in a generation. It happened in the 1990s with the internet. That was a once in a generation paradigm, and we had some very high concentration at that time. Is it fair to say, or is it stupid to say I'm not that concerned about the concentration?
I think so the companies themselves, from what I know, are still strong, right? In terms of their net income, their cash balances, whatnot. But if I'm trying to manage risk within a portfolio, that's where I get worried. So as you always say, the market's a voting mechanism, right? And the market has clearly voted for these superbly. But I just want to be aware of how much ownership I have, especially because they're the same 3 names, whether it's a blended fund or a growth fund.
Right, but you Wall Street guys, you always say you have to be aware. So what does that mean? What am I supposed to do to be? I'm aware now. Okay, I'm the Buddha. I'm enlightened now. I'm aware. So would I not do this?
There's another great point here, though, the AI phenomenon. I completely agree with you, right? You're not that worried because this is a massive trend, and Mag 7 continued can continue to do well. But where is AI going to go next? It's going to impact the earnings and the growth potential of the other 493 stocks. So totally, I agree. Don't give up on AI. It's phenomenal, but it's also going to feed down and benefit companies like Eli Lilly and Broadcom and even the banks even further, right? When they can figure out like their perfect credit risk analysis recipes. So. Well,
you've been trying to do this. You own ETFs that do some other things. I know, for example, you run the Connective Technologies, right? ETF.
Yes.
What's this? SIXG there?
6G and quantum.
Right.
Yes.
So this focuses on companies using connective technologies, like 5G networks or 6G networks.
Exactly.
Cellular equipment, what else? Broadband, something like that, and related infrastructure. But the ownership here is, in this ETF, is again heavily concentrated in chips and software. I think we have a screen of this though. It's NVIDIA, Broadcom, Oracle,
yes.
Apple, Cisco, Qualcomm. There we go. See, this is we're talking about a different ETF. This is the SIXG ETF, and this has done really well this year too.
Yeah, well, this is an AI ETF, right? So we look at AI and slice and dice it in different ways. We think that there's an AI energy story. We think that there's an AI quantum computing super story, and that's the quantum ETF. And 6G is connective technology. So it's basically that lower latency, that ability to process data quickly, that ability to communicate so that AI can actually work, right? AI is basically processing data in a very, very efficient way so that you can make it useful in ways we've never dreamed of. In order to do that, you need connective technology, and so that's where 6G came from.
Yeah. Now that makes a lot of sense, right? This has a theme to it that's very clear.
There's a lot of thematic noise, but this one actually makes more sense because it's going to be sustainable in terms of the build out of broadband and AI and whatnot, as opposed to some niche corner of the thematic world.
Right. So you still have a very heavy tech-oriented theme here.
Yes.
You have some other ETFs out there on tech-oriented themes that are also doing well this year.
Yes.
Again, I just want to get back to this point. The reason you own the S&P 500 is a form of diversification. If some of it is more concentrated than others, that's just the way the market is voting. And that's why I guess I'm not that concerned about it. This isn't pets.com, okay? If we were selling cat food, for $10 and, for free postage, which, by the way, is what Pets.com did. That's why it went out of business. I'd be a little more concerned. We're not even close to any of this. These companies are enormously profitable, and the earnings for NVIDIA have gone up, dramatically. Maybe not as much. The multiple has expanded a little more than the earnings for NVIDIA, but it's certainly not like eye-popping, unbelievable. We're looking at 30-some times forward earnings here.
They're much better fundamental footing than the comparison to the tech bubble.
Yeah.
I guess it's a nifty 50 market. I mean, I wasn't around for that.
Yeah.
I don't think many people were, right? But that seems to be the scenario now.
Yeah, actually I was 18 years old in 74, but you're annoying me now because you're starting to remind me how much older I am than you are. Okay, so we don't have to know about that. That was 50 years ago. I retract that comment about me being 18 in 1974. What else do you see happening in the ETF business? You've been around a long time. It's been a remarkable year. We have seen record inflows. We may have a record year. Don't we have a shot at it, Todd?
Yeah.
We could do $1 trillion in inflows?
Fixed income has already crushed their records. Equities on pace. I think it's going to depend on the next 6-7 weeks of performance if there's a chase. But it's coming from other corners. Crypto, the leverage products that are out there, non-traditional income, stuff like that. It's booming. And you're seeing all the product come out too, right, which makes things a little bit harder for us because there's a lot of inventory now to look at. But there is a clear
it is
wrapper
confusing.
Yeah.
What are the 3,000 ETFs out there?
More than that, and you're going to get conversions galore, especially as we're at a 24-year low for the number of active equity mutual funds.
Well, they're going down.
Slowly going down.
And well, it's not the number that I meant, it's the AUM. It's like 19 trillion.
Both, the number and the AUM.
Mutual funds are at 19 trillion, ETFs are at 10 trillion.
Yeah.
And it's been going this way for mutual funds, this way for ETFs for years. And so the crossing date is when?
Sometime this decade.
I think it could be 5 to 7 years, potentially. Yeah.
The wrapper shift is fully...
Think how much money the average investor is going to save by, instead of in a 100 basis point mutual fund, you're in pick a number, 20 basis point on average, ETF. 3 if you want an S&P fund, 3 basis points. I mean, think of how many billions of dollars the average investor is going to save. It's always amazed me how much money is captured in sleeping mutual funds. How many people seem to be, it's grandma's mutual fund. It's sitting there and they're charging you 2% for an S&P imitation fund, and nobody ever does anything about it because it's grandma's fund and nobody ever looks at it, you know? So I keep waiting for that. There's that slow conversion. As the grandma wakes up, or heaven forbid she passes away, and people notice it, and things get sold out and bought into other things.
Especially as 401k plans start to open up to ETFs as well. I think the next generation is just never going to take a mutual
the industry
fund.
doesn't like that, though, right?
They don't like that, no. But I think it'll happen.
Well, Fidelity, has a huge 401k plan, and they do offer that S&P 500 ETF in there, the Fidelity 500, I believe it's called. But these you can get them. You just have to look for them.
You have to look for them
amidst this ocean of active, higher.
Wait till they allow
management.
crypto.
Yeah, and I think that's coming too.
Yeah.
It's slowly eroding here. This has been a great conversation, folks. Sylvia, I think, has the right product for the right time. MAGS was the right product for this year and part of 2023. Maybe the X-MAGS will be the 2025 product. We'll see. That does it for this week's ETF Edge. My thanks to Sylvia and Todd. We've asked Todd to stick around and provide us with some additional perspective on this record year for REITs and ETFs coming up on the ETF Edge podcast. And remember, you can see all of our shows. It's on our website, etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.